Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about liabilities and specifically about current liabilities, what they are, why they're important, and how we can break them down into determinable and contingent liabilities. And then we did a bunch of different examples of determinable current liabilities. Now it's time to turn our attention to contingencies and see how they're recorded, how they're reported, and how we calculate the values that we can figure out for these unknown liabilities. But before we can do any of that, we have to talk about contingencies in general and what they really are. So let's start out by looking at a definition. Contingencies are existing conditions, situations, sets of circumstances that involve uncertainty as to possible gains or losses to an enterprise. They will ultimately be resolved when one or more future events occur or fail to occur. Wow, formal definition, isn't it? Really what we're talking about with the contingency are things we're not sure about. We think we might win this lawsuit. We think we might have to honor these warranties. We think we might be on the hook for some cleanup of a oil spill, etc. That's what we're talking about with contingencies. So they're just uncertain. We don't know how much and we don't know when. There are two kinds of contingencies. There are gain contingencies and loss contingencies. Gain contingencies have a very simple rule. You can't recognize them. Not while they're contingencies. They have to occur, and then when they're not a contingency anymore, they've actually happened, then you can recognize them for accounting purposes. Loss contingencies, on the other hand, if we can figure it out and come up with a good guess, then we'll record them or report them somehow. And that's why we talk about contingencies with our liabilities, because we just don't recognize gain contingencies, only liability or loss contingencies, and we show the loss or we show an expense and then we record a contingent liability. Let's take a look at some examples of what constitutes a contingent liability. So one example is litigation. We think we might lose a lawsuit. Now if we think we're going to win some money, then we don't record it at all. If we think we're going to lose, then we try to make a journal entry in the period where we caused this lawsuit. Now the hard part with litigation is if I put in my financial statements that I think I'm going to lose a lawsuit, then the people suing me could say, look, even they think they're guilty. They put it in their financial statements. So it's really nerve-wracking to put litigation in as a contingent liability. We see it sometimes when it's a sure thing. I mean, for example, the big oil spill that happened a couple of years ago with BP and the pipes in the Gulf. They knew they were going to have to make payments and they were going to get sued and they were going to lose. So they could go ahead and recognize it. The cigarette companies pretty much are going to lose lawsuits about cancer. Not always, but just about all the time. So they can put theirs in because it's almost a sure thing that they're going to lose. Sometimes the litigation shows up. We try to get it in as soon as we can, either when we know we caused an action that's going to get us sued or when we're sure we're going to lose, then we put it in to our financial statements. Next are warranties, and there's two kinds of warranties. An expense warranty is the kind of warranty that comes with the package, and we've all bought cell phones or cameras or tablets, etc. that say, hey, it comes with a free 2-year warranty, and it's part of the purchase price. That's called an expense warranty, and we record them as a contingent liability because we're on the hook for those warranties just because somebody bought our product. A sales warranty is different, and we've all had this happen as well. You buy that tablet, and as you go to check out, somebody says, hey, would you like to buy the extended warranty? Well, this is a separate sale. It's not part of the deal. It's not part of the sale of that tablet or phone or camera or whatever it is we're buying. It's something separate. It's more insurance against the item breaking. And because we're not obligated to honor this unless they actually buy the extra coverage, then we don't have to record it as a contingent liability. We just record those as they occur. Next are premiums and coupons. These are incentives to get people to buy our product. If we are obligated to honor these incentives, then we have to record a contingent liability. Now we won't do it immediately. If I issue a coupon in November, then I don't worry about recording it until we get to the end of December. And I think, oh, I've still got these coupons outstanding. They can still use them for another 2 weeks. Shoot, I'm on the hook for some of that money. So I do record in this year the number of coupons I think are going to come in those next 2 weeks of January. Next are environmental liabilities. These are typically referred to as asset retirement obligations, or AROs. This is basically the cost to clean up after ourselves. when we're done with an asset. So you can imagine a logging company having to go back and reseed the area and get rid of the roads that they were using, or a petroleum company having to get rid of its derricks and clean up any oil spills. If we build a factory and then we have to clean up the surrounding area from anything we dump, etc. That's what an asset retirement obligation or environmental liability is. We usually record it at its net present value when we build the asset, or when we first become aware that we're going to have this obligation to clean up after ourselves. So we don't record these at what we think we're going to end up having to pay in 5 or 6 years. We use the net present value and discount it back to today, because this is often done several years in advance of when we'll actually have to do the cleanup. Since we've recorded it at net present value, then over time, as we get closer and closer to the day when we actually have to do the cleaning, then we have to amortize away that discount because we've recorded it at less than we think we're really going to have to shell out. So we record interest expense over time on this asset retirement obligation, and it just becomes a normal interest expense as this ARO grows. Now, before we move on to our next example, let me just highlight something about AROs. They don't really fit in this chapter. They really don't, because they're long-term, not current liabilities at all. But this is when we're talking about contingencies, so this is when it fits, so we'll talk about it here. These have become huge obligations for businesses, especially mining companies and oil companies, etc. Because they become so big, this is a key concept, both conceptually what we've just talked about, and when we do the example here in a little bit, it's a key concept to understand what an ARO is and how it's recorded, because it's become such a big part of business in the United States. In addition to these environmental liabilities, another good example is self-insurance. Self-insurance basically means that instead of going to Blue Cross or Blue Shield or some other insurance company, we take care of the insurance ourselves. So we save up money, and when our employees get sick, we pay for it. And this is a good example of a contingency. You'd think, oh, everybody would have to record this if they were self-insured, because you know you're going to have to pay it. But FASB just basically said you can't, because you have no idea how much. There's no way you're going to come up with a good estimate on what it's going to cost to take care of this health care for your employees. So even if you think you know how much you're going to spend, even if you think you know when these payments will have to go out, it still doesn't even get reported in the financial statements. You just put in a disclaimer somewhere in your footnotes and probably in your management letter that you're self-insured and some of your guesses, but you don't actually put it in the financial statements. So that brings us to our next topic, and that is, when do we actually record our contingent liabilities, and how do we record them? Well, that all comes down to how likely it is we think we're going to have to pay. And we break it down into 3 possibilities. It can be probable, likely to occur. It can be reasonably possible, will probably happen. And then remote, it might happen. Now, there's no firm guidelines here on what constitutes probable versus possible versus remote. I would give a rule of thumb of about 80% and up would be probable, somewhere in there, 80 to 90, and higher, of course. Reasonably possible is probably in that 50 to 60 range, maybe 60, 70. Again, it's going to depend on the company. There's a lot of judgment here, but you think it's possibly going to happen. There's a really good chance if it's probable. There's a good chance if it's reasonably possible, and it might happen, maybe, but probably not. That's remote, and this would be anything below about 40%-ish. Now again, those aren't FASB's percentages, they're just mine to give you a sense for what we're looking at in these 3 categories. Now the fun part with this is deciding how they get classified now that we know how likely they are. If it's probable, and if you can come up with a good estimate, so it's estimable, I just love that word, estimable, then you put them in the financial statements. They get a journal entry, and they get reported officially in the financials. If they're probable but not estimable, and this is where healthcare costs come in, they're not estimable, but they are probable, then you put them in the footnotes and disclose them. That's what we say when we put something in the footnotes, is it's disclosed, not reported. Reported means it's in the financials. Disclosed means it's just in the footnotes. So if it's probable and estimable, then it goes in the financial statements, it's reported. If it's probable and unestimable, then it goes in the footnotes, but not in the financials. If it's reasonably possible, either estimable or not, it goes in the footnotes. It's disclosed, but doesn't go in the financial statements. If it's remote, as far as FASB is concerned, it doesn't get reported at all. Now, even though FASB says you don't have to disclose it, because of our litigious society, all the lawsuits that happen all the time, most business leaders will still disclose remote possibilities. They can't do it in the financial statements because FASB says you can't. So instead they'll put it in what we call the management letter. And this is not an official part of the financial statements, but it comes out with the financial statements, usually in the same packet. It's just not audited and checked and not reported as part of this formal financial statements section. They're really actually kind of funny to read. What companies and management teams are doing is they're just trying to cover themselves from being sued later on. They want to be able to say, look, this happened, but we warned you it might happen. You can't sue us or the company or us as the board of directors because we warned you this was a possibility, even though it was a remote possibility. And there's lots of examples we could turn to. My favorite was Pixar's, way back when it was an independent company originally, because they would put things in their management letter like, you know, we're doing really well, but people might decide they don't like movies anymore, and then we wouldn't be doing really well at all. Or people might decide they like movies, but they just don't like cartoons, so then we wouldn't be doing very well either. Or people might decide they like regular movies and cartoons, but they don't like computer-generated movies, and that would hurt us. All of our computers might break all at the same time, and we couldn't make our movies. And so on. Now those are maybe a little bit of an exaggeration, but that's the kind of warning we're talking about. They're not very likely, but they go in the financial statements, they go in the management letter, because companies want to make sure that they're covered in the event that it does happen. They just don't want to be sued. These three classifications and what we do with numbers in each classification is another of our key concepts, because you really can't do contingencies unless you're comfortable with these rules. Now, under IFRS, we don't call them contingencies, we call them provisions if they're going to be reported. So those that show up in the financial statements are provisions. The ones that don't get reported, they're contingencies. So they actually use a different word to break it up. So if it's probable and estimable, then it's a provision under IFRS. If it's probable and not estimable or reasonably possible or remote, those are contingencies under the IFRS rules. So the basics are about the same. The real difference is in the amount that you recognize. In US GAAP, we recognize the low guess of what we think this is going to cost us. So if we think we might lose this lawsuit and it'll be between $1 and $2 million, we'll record a liability of $1 million, not the $2 million, the $1 million. Under IFRS, you'd have to show the middle of the range. So I think it's going to be somewhere between 1 and 2 million. I'd record $1.5 million. I think it's interesting that as much as we talk about conservatism, nobody records the worst case scenario. It's the best possible scenario under US GAAP and the middle of the line scenario under IFRS. Now, if you have a specific guess, you use the specific guess. We're just talking about ranges here, but I still think it's interesting that nobody uses the high end of the range. IFRS also requires that they update the amount of their provisions each period based on risk adjustments. Under US GAAP, we recognize changes because we think we'll have to pay more or less, but not because of a risk adjustment. So that's an IFRS requirement. Finally, these provisions get grouped together, usually in one line item, called short-term provisions, on the statement of position or the balance sheet under IFRS. So you won't usually see a bunch of small provisions, you just see this one big clump with all of them together, and then you have to dig into the footnotes and figure out, wait, how much is for warranties, how much is for coupons, how much is, etc., etc. The long-term provisions get their own line item, and that's where the asset retirement obligation would go. We've talked about a lot of stuff with contingencies. What we need to do next is do some examples, and we're going to start that in our next segment. I'll see you then.